Thank you all for having me today. What I thought would make the most sense, since I have spent really my entire career on Wall Street and my entire career in equity research, is sort of go through really the basics of what equity research is, how it works, how the different components of research, meaning who is involved in terms of the level of support I have in my team, the different opportunities here, and really what's involved kind of on a day-to-day basis in terms of really creating a powerful and successful franchise. Just a really quick background on myself. I graduated from the School of Foreign Service in 1989, worked in a political think tank for a couple of years, and then went on to get my MBA at Stern. And then really, very quickly, I did a very brief stint in management consulting, but very quickly went to equity research and spent the last 25 years really doing media or media related research, first at Bear Stearns and then at JP Morgan when JP Morgan acquired Bear Stearns in 2008. I've known Tom for a very long time, most of my career, and he's been a wonderful mentor to me. And I agree with him. That's really how this business works, everybody has a different franchise, and I'll get into it more specifically in a minute. Every analyst covers one segment of the market, one industry, and everybody does it a little bit differently. I'm going to talk about how I do it and how it's structured, but it's watching people, how they succeed, and picking and choosing what you've seen from them and what works, and trying to mold that together into your own strategies is really how I think you become very successful. You're taking the best of your peers and obviously being very knowledgeable in what you do. I was just going to say also, if anybody has any questions, please use the chat function, raise your hand or whatever it is. Raise your hand and we'll call on you. I think that is. We do want to keep this as interactive as possible. I don't want to sit here and lecture you guys. I want to hear your questions and try to give you the answers that you're looking for. So with that, I'll go to the next slide. If I can figure out how to use this correctly, you'd think after 2 years of, there we go. Okay, so just to start off with, I cover media, super fun sector, honestly. And I cover really every kind of stock that really is sort of involved in media. There are exceptions. For example, I don't cover Netflix because the internet analyst grabbed that early and he has it. I don't cover like cable, which might own media assets, because the way the department or the way equity research is set up is you have a senior analyst for every segment of the market. So I cover media. There's a cable telecom analyst. There's an internet analyst. There's a healthcare analyst. There's an insurance analyst. Et cetera, et cetera. And so the department head kind of carves up the coverage, and you come in. And you have a sector, or you grow up into a sector being a junior analyst, and you're really responsible for that sector. So what does that mean? Here on this sheet here, as you can see on the slide 2, I cover right now 33 stocks, and I've listed them in sort of subsectors here. Basically, it's entertainment, it's ad agencies, which are sort of marketing or media related, cinema, live entertainment, video games we picked up a few years ago because it's become such a part of entertainment, and outdoor companies, which is really billboards and stuff. The way, again, a sector can be sort of carved up and changed depending on how the department head defines it. The stock coverage is fluid. And what I mean by that is, I don't only cover these 33 stocks for 25 years. I've been doing this for 25 years, and this list has changed over the 25 years because things in industry change, right? I mean, video games, really didn't exist in the way they exist now 25 years ago. Same thing for pretty much every company on this page. So it morphs is what I'm trying to say. And then beyond that, there are companies that grow and become more important, like Roblox. That is something we felt was necessary to cover. Didn't really exist several years ago. And now it's a really big, powerful name. So we cover it, and companies become less relevant too, and we may choose to drop them and not cover them. Also, there are IPOs, there are companies that go public that JP Morgan may or may not be involved in, and we would then naturally, cover that as well, because if I'll get into this later, but if the investment bank side of a bank does a deal, it is sort of I guess it is a spoken rule. It's just sort of an understanding that the research side will then pick up coverage of the stock. Let me just explain real quickly what coverage means. Coverage means that I officially have a rating on that stock. I'm responsible for that stock for the bank, which means that if an institutional investor, Fidelity, Putnam, someone who manages money, has a question about that stock or wants to learn more about that stock, they then, look to me, Alexia, the research analyst, or my team, or my written research to find out about that stock. And we'll go into how the communication works in a little bit. I do want to highlight, I'm going to get into this on the next page. I myself directly am not the lead analyst in all 33 of these stocks, because over time, I have a team, and I'll go into that in a minute, but over time, as my team gets more senior and proves themselves, I give them the opportunity to cover one of the stock or a couple stocks on their own. Again, trying to, develop them over time into a senior analyst. So some of these smaller names, for example, CuriosityStream and Fubo, one of my vice presidents on my team recently picked up, and she's sort of cutting her teeth with them. You tend to do that with the smaller stocks. Like I would give Disney, which is one of the biggest stocks I cover, to a junior analyst, because obviously you want them to start off small and kind of learn that way, and then eventually have the opportunity to cover stocks on their own. I do want to point out that I think you're hearing from Tim Nolan. Is it tomorrow? I think it's tomorrow. He was my junior many years ago. He's an amazing analyst now. But my point of saying that is, you can come in as somebody's junior, learn from them, support a senior analyst, and then go break out and have your own career and be your own senior analyst. It's a great I think it's a great training ground. I did that myself. I left my senior at Smith Barney years ago, and became my own analyst. And Tim Nolan has had a great career as well, and he's done the same thing. I'm going to move to the next slide. Hold on. All right, hold on. Let me get back. I think I skipped one. Okay, equity research overview. Let me just touch on the team, because I think it's important to understand the roles that are involved in equity research. There typically is, every senior analyst typically has anywhere from, I'd say, 1 to 4 supporting team members. It could be someone right out of college, which is an analyst. It could be someone who either came right out of college and then worked for a few years, and they can be an associate or it can be a vice president. We hire either students right out of college, or we hire MBAs. I would say that the trend in the industry has been to lean more into hiring students right out of college. I just think the value, at least from equity research point of view, placed on the MBA is a little, I think, maybe less emphasized today than it was years ago. Both are valuable. We look at both, but I would say we tend to skew more with younger analysts out of college at this point, a little bit more so than the MBA grads, but both obviously get opportunities. In terms of how this team is structured, so you have the analyst right out of college, you have the associate who could have a few years experience. The vice president is typically someone who's moved up within the role and can eventually start taking their own coverage. And then, of course, there's the senior analyst. In terms of what you do in those roles, the analyst really will do the basic stuff. They will build the model, they'll start doing the research for the report, they'll follow industry data, they'll send me the important news every morning in terms of what news is impacting the industry or the stocks we cover. And then as you move up, it's sort of natural. You'll write more reports on your own. You'll build more complex models. You'll do some valuation analysis. You'll actually talk to the management teams and investors. And then as a vice president, like I mentioned, you can do more of the same, in a more sophisticated manner. You can also start covering some of your own stocks if that's what your analysts, some analysts don't believe in that. Some do. I always do. So my vice presidents, the two that I have on my team, I have 2 vice presidents and an analyst. The 2 vice presidents both cover their own stocks. Let me go to the next slide. All right. Okay, here we go. Product lines. Types of research. Let me just take a step back, and then I want to jump into what we do actually write and walk up through these reports. But the whole point of equity research, right, is to be the expert on these stocks and have an incredible brand and recognition, so that if anybody whether a big investor, a hedge fund, a small investor, if anybody who's a client of the firm who pays JP Morgan in this case has a question or wants to know what to do with the stock, they think to come to Alexia for media. To give you a perspective of the landscape, I have approximately 30 competitors. So there's 30 other people roughly, whether it's Goldman Sachs, Morgan Stanley, or smaller boutique sell-side firms. We call them sell-side if you are doing equity research, the role I do, that do what I do. So it's important to do a very thorough job, and two, create a good brand and reputation, because you want somebody who wants information on the stock to always think of you first. So it's sort of like be the best in the industry. Doesn't mean you'll talk to everybody, but you definitely don't want to be number 15 or 16 or 17, because the odds are you're not going to get the calls from the important banks. So the most important thing is to have an incredible brand, an incredible franchise, incredible reputation. How you get there, there's a few ways. You have to have the top models, the top financial analysis, and you have to write really strong research reports, because if you publish strong reports, you have something, good analysis, good research, you have something to talk about. And when you have something to talk about, you get recognition for your stock call, for whatever you're talking about. You get recognition for the work you've done. The more recognition you get for the work you've done, the more you build your brand. So it's sort of there's pieces to the puzzle. There's financial analysis, there's written research, and then there's sort of the marketing, branding of the product. And as you can imagine, the younger people in the group will do a bit more of the legwork, the financial modeling, the written work, and I'm really the face of the team. The marketing person, the one with the brand. Doesn't mean I'm not modeling, doesn't mean I'm not editing or writing research notes. I'm doing all of that. But I think the more senior you get, the more you're about conveying your position, conveying your investment thesis, conveying your knowledge, and less about the day-to-day work. Now, having said all that, I want to get back to the type of research reports we write. Now, there's several kinds of research reports we write, because the point is we want to, again, be the point person for any stock. So if there is breaking news on Disney, we want people to pick up the phone and call Alexia, people to email Alexia. It always has to be Alexia associated with the big media stocks. And if we have regular written research that's always in front of them in their inbox and their email, they always know we're on top of the story. So what is the type of research we write? Well, there's first thing we write, and I'm going to give you an example of this in the next few slides, but I'll review them here quickly. We write initiation reports. So when we are launching coverage or starting coverage on a new stock, and I think I use Roblox as an example. Let me jump to here and I'll go back. When we're launching coverage of a new stock, we picked up Roblox a year ago, which means we basically decided this was not associated with the banking deal. So it was our choice to cover it. It wasn't something that we were had to do in that sense. When we launched coverage on Roblox, we basically thought this is a big stock. A lot of in terms of market cap, a lot of investors are asking about it. And we want to cover it to sort of help build our franchise. And we're expanding more into the video game area of our coverage. And we thought this was a key player in the gaming. And we wanted to have it under coverage. So what we did is we basically went out, we met with management. I think it was during COVID, so it might have been virtual. I can't remember. We read it in the industry, studied about it. We built a financial model, met with management again, and formulated an opinion on what we think about the stock. And you can see here it's overweight rated. So we actually have a positive view on the outlook for the stock. Now, in an initiation report, we basically come up with a rating, which is simply put buy, hold, or sell, but we call them overweight, neutral, and underweight at JP Morgan. And then we write our investment thesis. It should tell you the name, the beginning of the name, the ticker, the market caps, basic information, and why we like the stock. It has to be short and to the point. People read so much, everybody's got ADD. You've got to kind of get to the point across as quick and as focused as possible. So you get a lot just from I think this report is probably, I'm guessing, I can't remember, 30 pages, 40 pages, 20 pages, something like that. But you want people to read the first 2 pages and know exactly what you're saying. And then they could go to the rest of the report if they're interested in going further. So on the first page, we'll put, what we like about the stock, important information about the stock. And then you can see here, the next couple of paragraphs, some key considerations to support our investment thesis, going into a bit more detail why we like the stock. And the last paragraph always has a bit on the front page, which is valuation. How is this stock valued versus, what we think their competitors or their peer group is, and why it should trade either higher or lower than their peer group, because it grows faster, has more opportunity, whatever it is. So this is an example of an initiation report that we put out last year. Okay, let's go back a minute. Okay, other reports, we have primers or sort of thematic reports. It's funny that Tom probably remembers the Ad 101 because I've been putting it out for about 20 years, but people still read it. So what our primers are, they are intro to kind of a book with a shelf life, I'll put it that way. Our Ad 101 is a great example. We have one on the video gaming industry when we launched. It's sort of an introduction, the 101 sort of, says so in the name, into what, into a sector, into a theme, into an area, to kind of give somebody who's newer to the industry a good kind of overview. So the reason we keep doing this every year and the reason it's so important and so valuable is you can imagine investors change all the time, right? So whoever, maybe owns, I don't know, Omnicom, which is an ad agency at Fidelity, Fidelity's notorious for changing the roles. So the guy that covers the ad agencies at Fidelity this year could be different than the guy that covered it last year. So the new guy coming into Fidelity may know nothing about the ad market, and will look for a primer or some thematic report to kind of teach them in terms of what are the key data points to look to, how can I learn about this, what are the stocks involved in it. So that's why we write these primers or thematic reports, because I think they're very valuable, particularly to new people on the buy side and investors. We also try to keep them fresh. So in the Ad 101, for example, the first 5 pages is an executive summary of the current trends. So even folks that may have read it before will still want to look to it to see the update in terms of what my current thought is, looking into this coming year on whatever the theme is that we're writing the report about. So let me give you a quick look of what the primer looks like. This is it. This is the Ad 101 here on page 6. You can see here succinct bullets, sort of trying to summarize the theme of reports. It'll sort of expand on it a bit in the second and third bullet. You have to always bring stuff back, I think, to a stock, because and that's why we talk about relevant stocks here in a later bullet. There's some people that want to read on Wall Street just because they're interested in an area, but generally it has to come back to a stock, because if you're wanting to learn something, you're going to ask the question ultimately like, well, how am I going to invest with this knowledge? So we try to tie everything, even these thematic pieces, back to a stock. And then, like I mentioned before, always on the first page, we want to end it with kind of the thematic takeaways or the sort of key points. Everything really, all the summary has to be on the first page. And then I know this is a 120-page report because it's a bigger primer. But then if they feel like they want to go in and look in and learn more, you've got the whole report to kind of refer back to. So those are primers, and I'd say we put out 2 or 3 a year, different topics, obviously, and they're annual pieces. Then there's sort of monthly or sort of periodic, I'd say, sort of reports. These are more thematic. Let me give you an example. The streaming wars, right? I cover, except for Netflix, I cover all the streaming video on demand businesses. So all the media companies, Viacom CBS has Paramount Plus, Discovery Warner has, HBO Max, obviously Disney is Disney Plus. So because those are so much a focus by the investment community, but also the big area of investment and growth for all the media companies, we spend a lot of time on it. I'm not just talking about watching the shows. We do that, and we talk about it in our group meetings, but we also spend a lot of time on, how many subscribers are they adding? What's the ARPU? How quickly can they grow? How much are they investing? And investors always want to hear about it. We even had a podcast on it for a while. So we put out monthly reports in terms of the streaming wars, who's winning, who's losing, meaning who's, what's really kind of what's going on. We have a report called the DTC Roundup, kind of the big hits, like when I don't know, Emily in Paris came out, I would say, on Netflix, even though we don't cover, we talk about Netflix. We have to, it's relevant. When something like that came out, we talk about, is Netflix going to gain subscribers? What does this mean to some others? I'm noticing here there's chats. Let me just finish my thought, then we'll go into the questions. So there's always something to talk about, and investors love it because they want to make sure that on a regular basis, like in a monthly way, they're up to speed on trends, which will ultimately impact their investments or potential investments, because growth in streaming services is such a big data point right now for almost every media company, because again, that's the growth strategy longer term. All right, I'm going to take a pause and look at this chat here.
So, Alexia, most of that chat is, I've just been kind of
commenting, okay, so they're not questions.
Another question, letting people know resources that Georgetown makes available. Perfect. To get Emergent InvestTech makes available. Although Rena did ask, and it's actually a really good point, do you have ESG component to your analysis and reports now? Obviously, ESG has become incredibly prominent.
Yes, we do have ESG components. Well, let me put this on. We have a ESG team at JP Morgan, and we have ESG reports we can write or contribute to, and we have an ESG conference at JP Morgan. I would say, surprisingly, we don't get a lot of questions. I say surprisingly because people often ask, who talks about ESG. I would say on an analyst-specific level, and maybe there's some industries where it's more relevant, right? If we had a tobacco analyst, which we don't have, it'd be very relevant. But surprisingly, as a media analyst, I don't get a lot of questions on it. But I know JP Morgan is making a bigger effort in it. And I know we have this big conference coming up because Disney is speaking at it. So I think it will become much more prominent and probably embedded in more of our research, I would say, going forward. Just going back to here, I would say, jumping to next, actually, let me show you if I think I have an example of a monthly. Yes, this is just the example of our monthly, the DTC roundup. So it's actually a really fun piece if you like, streaming platforms and learning kind of where you can see here, we talk about 1883, which was the prequel to Yellowstone that Viacom launched, and how it really is helping their platform, Paramount Plus, because they sold Yellowstone to Peacock, so they don't have it on their own platform. We talk about what Netflix is doing. We talk what Apple's doing. So it's actually, even as a consumer, I think it's a fun read. But it's one of our more popular pieces right now because I think the investors always want to make sure they know what is going on with the streaming platforms. Okay, so going back to here, company-specific notes. This consists of, again, like I started off saying, I am responsible for, the 33 stocks that I listed. So if ever something is going on, I'll use Disney's example. With Disney, I need to have an opinion on it. I need to have an opinion on how it's going to impact the stock outlook. So because of rules of fair disclosure, we really can't tell, investor X something if it's material unless we put it in a published report. So what does that mean is we're constantly writing reports. I wouldn't say daily because there's not daily material information that's coming out on Disney. We are writing reports daily, period, because we have 33 stocks, but we're not writing them daily. We're writing them often. I would say a stock as big as Disney, which is a few $100 billion market cap, we're definitely writing on them, I'd say at least once or twice a month. So anything notable we want to put in print. So that way we're comfortable sharing it in public, to investors, to people outside of the firm. And that could be, let's see, what did I use an example? I think that's earnings. Maybe I didn't put an example of a company specific note. Oh, there's different examples of them. So we will write a company specific note on breaking news. We will write a company specific note on changing earnings estimates. If we decided, we don't think our estimates in our model are not close to where they're going to come in, we can basically update our model. And if we want to publish our model again, we have to write a note. So we could write a note on our changes in our estimates and why they changed, where they changed from, where they're going to, and why they changed. And we can, write a note on breaking news. We can write a note on on updated earnings. As you guys know, companies report in this country 4 times a year, less than that in some other countries, but here 4 times a year. And and that means we're updating our model when they report. We've talked to management when they report. We listened to their conference call. We looked at their Q, and all that new data, obviously drives us to update our estimates and update our thoughts on the company. So every time a company reports earnings, we always will write a note. So you can assume at minimum, and this is real minimum because we do more, we will write on those 33 stocks 4 times a year. But it's a lot more than that. And to give you a quick idea what an earnings note looks like. Lionsgate, this is a film TV studio that also owns Stars. Here we basically talk about, the headline has to be, what was our first impression? What did the earnings release? What did we learn? What was the biggest takeaway? In this case, the takeaway was, the results showed improvement in margins, but however, the important takeaway here is we are reducing our estimates going forward because they're spending more money in content. So you have to have sort of a headline so you get investors to actually read it. And so it has to you can't just say updating our model or the company reported. You want to give the real quick takeaway, so they want to kind of dig in and look further. So that's what that title is. And then we try to summarize the results less, because anybody can look that up on the news, right? Or find it in a filing, but try to take what they report and offer our opinion. So give them a little bit of information about what they reported, but more likely actually just sort of tell them what our opinion is and our interpretation and our analysis and what this new data in terms of their new earnings, what it means to us and our investment opinion. In this case, we have an overweight on the stock, really because we think it's going to be taken out. But what they do on a fundamental basis is still relevant. So we do write about it here. Okay.
Alexia, there's a really good question in the chat. What was it like covering AMC at this time last year? What effect do you think the growing number of retail investors using platforms like Robinhood will have on the market moving forward?
Great question. For a very odd reason having to do with investment banking, we actually didn't cover AMC Entertainment. It often gets confused with AMC Networks. And actually, I'm glad you asked that because it's a very funny story. There's 2 stocks. There's AMC Entertainment, which is a movie theater. And there's AMC Networks, which is a cable network. If you think The Walking Dead, you guys are familiar with that. That was on AMC Breaking Bad, AMC Network. So we cover AMC Network, and the ticker is just 1 letter different between AMC Entertainment, the movie theater, and AMC Network. And it is interesting. We had a sell on we don't cover AMC Entertainment, the meme stock you're talking about, which had the huge crazy ride, thankfully, because it would have been very challenging to cover it because, again, the movement in the stock was not based on anything fundamental. And it's really hard, and that's what we base our research on. We listen to market sentiment, we talk to people, but our research is based on fundamentals, and to cover a stock that moves purely on speculation and sentiment would have been very, very challenging. So I'm grateful we can cover it. We don't cover it because there was some issue on the investment banking side. So wasn't a very big stock, so it wasn't missing in our coverage. But interesting enough, we do cover AMC Networks, which is the cable network. And so many retail investors actually confuse the two, which you think someone who's putting money to work actually would find out the appropriate ticker, but they didn't. And so AMC Networks, which we had a sell on because we're not very bullish on cable networks, went up enormously. It doubled. And it was 100% because people confused the 2 stocks. Eventually it came back down, but it was very odd to see that. But I think that's indicative of the insanity that was going on at the time with these meme stocks, and the fact that you just had this irrational investment, based on rumor and the retail investment community rather than fundamentals. So that's my little story on AMC, but unfortunately not on AMC Entertainment, because we don't cover it. Okay, going back, where were we? Okay, alerts. I do want to talk about alerts. There's a lot of restrictions in equity research to try to keep it fair. A lot of these changes happened about 20 years ago, and there's some regulations naturally about what we can and can't do. And like I mentioned too, we can't talk about a new material piece of information unless we publish it first. So what we can do to kind of get things moving faster is we can write alerts. And this is basically a shorter note that requires less of the components that I showed you in the other note. You don't have to put your model in it. You don't have to talk about your price target. You don't talk about your earnings. It's just a quick opinion. And so I actually put the Athletic and New York Times in here, but I think one that's more interesting that I will talk to is when it was announced, or I don't know, even not, I guess when it was announced that Microsoft was going to try to buy Activision. We cover Activision. We don't cover Microsoft. Another analyst covers Microsoft. I thought it was important to right away put out a note and tell investors, what our thoughts are. So what would be relevant for the investment community? Because we wouldn't want to just copy the press release, right? About they're going to buy Activision. So what was relevant is we wrote a quick alert within an hour of the news breaking. And we talked about what is the likelihood of the deal going through? Because what was interesting at the time, the stock opened close to the takeout price and then end up trading during the day kind of at a huge discount to where it was being taken out. Obviously indicating, we talked to our risk arb desk and got more information indicating that there was a lot of skepticism that the DOJ will approve this deal, so it may not go through. So we talked about what our thoughts were, the deal going through, why it may, why it might not. And then the other thing that was important to do is to address, what does this mean to other stocks in the universe? Because the first thing investors will think, oh, Activision is already up, I missed it, Microsoft's buying it, now what? They'll think next, okay, well, can another video game company be taken out? And who's going to buy it? So you want to take it one step further. So in the note, we also addressed, what other stocks could be bought in this space and why? And in there, we specifically talked about Electronic Arts. They have FIFA and a bunch of other games, I'm sure some of you will know, and whether or not that was a takeout candidate and why not. So that a quick alert is a quick reaction to some breaking news to get your thoughts out there. And it's very efficient because all of a sudden you're addressing, what the top 3 questions the investors are going to ask. You're putting it on a note, the note's available to all the clients. It's a very quick way of sort of getting your messaging out automatically. And the last thing, which is probably the least relevant or least interesting of our notes, is really industry conference notes. And this is, let's say, if a company speaks at a conference, not everybody attended the webcast or went to the conference when it was in person. So you want to write a recap of what the management team said at our conference.
Alexia, if I can sort of just chime in, there's 2 things. First of all, James asked, did you cover the Wordle acquisition by the New York Times yesterday, which, by the way, low 7 figures. I don't know what low 7 figures meant. We could discuss the valuation there, but Guillermo asked, and this fits with the industry conference, and also you were talking about AMC, and something that academics are always concerned about. Are there any conflicts of interest between equity research and other divisions in the firm, right? Famously, the idea of the Chinese wall, which is you're not supposed to be talking to the investment banking side. And there was then a big push towards independent investment analysts. So you wouldn't have this sort of conflict. But Guillermo was saying, are there conflicts of interest? Do you see it in the industry? How might you deal with this? How might our students deal with this? If they take a job on the sell side?
Great question. On the first one, real quick on the Wordle, too small. I mean, yes, covered it. Yes, looked at it, didn't write on it because, again, my concern is New York Times, and it just wasn't material enough to warrant writing. And it's not going to impact our investment opinion, and probably would impact our estimates. So at this point, if we get more information from New York Times when they report next week, we will update our model, maybe discuss it in the note, but at this point, a little too small. We're not going to write on stuff that's not material, but good question. And the second question, great question there, which is conflict of interest. It is a very important question because I think it's something an analyst works with constantly. And the rules when I started this job 25 years ago and the rules today are very different. I would say the wall is a lot higher and there's a lot more watchdogs on it. Today, there's so much regulation. There's so many watchdogs. You have a lot less conflict in the end of the day. You have a company that goes public and the bankers obviously supportive of it. They're getting fees. You have 100% independence. I'm not just saying this. You have 100% independence to write whatever rating you want and whatever research you want. really with minimal to no pushback. Now, let me just give you a caveat. If we're working with lawyers on the deal, which we are, lawyers and bankers on the deal, lawyers always on the phone, we are constantly helping them with evaluation range. And I'm going to get into our role in banking in a minute. We're constantly helping them with evaluation range. We're constantly helping them formulate the deal. There's a lot of investment banking work associated, at least with media, not every sector. And we're always working with banking. So it is very unlikely that you have an absolute hatred or really dislike or see really big red flags on a deal that you have to cover. And I'm saying this because we have to go, the analysts will go to commitment committee before the deal gets approved. So you have plenty of times to voice your opinions. So is it possible that a stock comes out that you've taken public as a bank and the research analyst puts a sell on it? Yes, it is possible. And you can do that without any negative ramifications. It's totally fine in today's day and age. It just doesn't happen that often, because the only reason it would happen is if the stock really rallied and the valuation was at a point where you no longer felt comfortable recommending it. Because if you found something fundamentally wrong with the company, the bankers didn't have to listen to you, but you did have plenty of times during the process to voice that. So it would be less likely the company would have proceeded with the IPO, at least in that valuation range, if you had raised that many red flags. I hope that makes sense and answers your question. I will get into the banking relation because I actually think it's very interesting, particularly if you're thinking about going to investment banking. Okay, let me move on because away from this written report. All right, go through all these. Okay, the research, I'll just do this briefly because I do think we want to talk about banking for a bit, but let me just go through this briefly. The research process. In order to initiate coverage on a stock, you obviously pick a rating. You build a model, you have financial projections, and then you basically write a report walking through, what the company does, but more importantly, your investment thesis, what you like about the company and what you don't like about it. Risk, basically investment positive, investment concerns, and then you have a good section on how you value the stock and how you how you come up with your estimates. It's pretty basic in that sense. You could give some industry information. When we launched on video games, we put a big report out on the industry, and Fortnite was very topical then. We talked about Fortnite, even though it was not a public company, because it was relevant to the stocks. But basically, you just write a report on the company and then talk about your outlook on the stock. Once you put you have to go through a committee in the department. It's not a big deal. It's your department head, usually a lawyer, and you sort of present your ideas. The more senior you are, the less pushback you are. For the more junior people, they'll kind of try to nitpick on the report and try to make sure you know what you're talking about. But they approve it, you publish it. The morning you publish it, you go on the morning call. Very briefly, the morning call is basically where the analysts will go, and now it's in Zoom, but back then it was in person. You'll go speak in front of the sales force, and you'll basically tell them in 3 minutes or less, because there's a lot of people that speak and they want you to be to the point, what you're trying to convey, and you won't just go on the morning call with a initiation piece. You can go when you want to reiterate when you want to get notice from the sales force. We have an interesting note coming out. You want to change your rating. You have a big call on a stock. You will go and speak to the sales force for 2 to 3 minutes and tell them your quick summary of your ideas. So you do that when you initiate with a stock, and then you follow up on the phone all day with the investors and with the sales force, and you basically try to market your call on the new report.
Alexia, if I can kind of throw in a couple of chat questions here that came in. Ryan asked, and I think this is great, what are the most common writing or research mistakes or omissions you see young analysts make? All right. Obviously, it takes time to learn learn that. And then the other thing about that is Christian is asking about when you analyze companies, whether it's the young analyst or you're doing it now, do you rely solely on the metrics given by management, or do you rely on third-party data sources?
Two very good questions. The first one, common mistakes, hopefully they're caught before it gets published, because if it's a meaningful enough mistake and you have to publish a retraction, it's a little embarrassing. It happens. not the end of the world, but it happens just because it's on the news wires and everything, you got to retract it. But there's so many checkpoints because, you write a report, you don't just press send, it goes through a whole compliance approval team who then checks with the other sides of the bank. Is it okay that you write this? They check for language that's not appropriate, so there's checkpoints. It's like you got a few proofreaders along the way. So the odds are of you putting something out that was either inappropriate or not allowed, slim to none. So the mistakes that go out that aren't caught by these people would be mistakes in your model, where you said the wrong thing. Like if I didn't proofread and I had a junior person who didn't do a great job, maybe they said we're raising our estimates when we're lowering our estimates, things like that would be more likely to go out that you would. Again, I think it's rare if you've been doing this for a while because you know what to look for, but it happens. I've done it. I've made a mistake. Again, not often, but I've made them. But it's something like that. It's not going to be something that has a legal nature, regulatory nature to it, because you have checkpoints that watch it before it go out. On the second question, oh my God, I just blanked what it was.
It's the metrics, right? Do you just rely on
Yes,
management,
yes.
or do you have third-party services?
No, great question. 100% don't rely on management. We talk to management all the time because, first of all, when you're on a phone with a client, you say, I just spoke with management, they always pay attention and listen. So it's always good to be in the flow. And we talk to management all the time because you don't, to your earlier question, you don't want to ever be wrong, or at least you want to try not to be wrong as often as possible. So bouncing thoughts or ideas off of them, you can't come and say, we're going to change our numbers or we're going to change our rating. That's not allowed. But you can say, I heard, the third-party data, we buy a lot of third-party data, particularly on the video game side, on the mobile side, to see what downloads are looking like, to get a sense, New York Times as an idea, or Activision, what Call of Duty download, who's actually buying Call of Duty, how much time is spent online. We look at the Twitter feeds and seeing how people are, talking about it or watching it. So a lot of third-party data, because it's more valuable, because it's independent, much better source than just talking to management. But I will say, if we see something notable on the third-party data, I would more likely than not pick up the phone. And Activision, the video game companies really don't tell you much, but like New York Times, I pick up the phone, I'm saying the third-party data is showing that the subscription growth in the quarter really is slowed down in November, December. Have you seen that? What do you think? They may not comment on it, but they could highlight, oh, you know what, that's because of X, Y, and Z. And all of a sudden you've learned something to kind of add to the third-party data. So the answer is a combination, but you don't want to be a parrot for the company, right? You're not their PR agency. So absolutely do independent research.
In the context of that, Will had asked a question that I had to go back for, which is, how do you measure your progress or performance? When I teach valuation, right, we talk about modeling, right? You're predicting the future. You know this better than anybody, Alexia. It is really difficult to predict the future, even if you have the model right. Things happen, and so the question is, especially in a fragmented space with 30 competitors, do you strive to be right in hindsight, or is it your goal to ensure you have fundamental analysis to back up your positioning regardless of what happens with the stock? And so I guess I'll rephrase Will's question to, is it okay to basically have good analysis and end up being wrong because things went a different direction?
It's funny. I have a junior who is taking on a more senior role, and he's excellent, and he's always trying to wants to make sure he's right and do the right thing, and get it perfect. And I constantly tell him, and Tom will remember, Dana Telsey, this retail analyst that was, she, again, every analyst does things differently. She was so great with branding and marketing. And I learned this from her many, many years ago. I constantly tell him, it's always better to be visible and out there than always being right. Now, having said that, of course, you want to always be right, and you don't want to necessarily, you don't want to go out there if you think you're wrong. I'm not saying that, but it's better to make the call than not make the call, to make sure that you are 100% right and perfect. Get out there, be visible. You're not the person responsible you're not the buy side, right? The PM, the analyst, the hedge fund manager, whoever it is on the investor side, he's responsible whether to buy the stock. What your goal is to make sure that he listens to you and looks to you and wants to read your research more than anybody else and talk to you when he's trying to develop an opinion about whether or not to buy the stock. The other point of your question was, how much do you sort of, I think you said go with the fundamental analysis versus kind of go with what you think. I mean, I guess at my level, because I'm just doing this for so long, some of it is gut feel. Some of it is sort of, oh, this is where the market, I look at the market trends, I look where people are buying, selling. You just sort of learn over time to kind of interpret data and know which ones are more important than others. But you always want to do some analysis, right? You can't just sort of say, oh, I think Netflix is going up because I really like that show. You have to kind of put the pieces together. Okay, they have this, Squid Game, is how many, you got to sort of take it to the next step. Like how many subscribers, who's watching that didn't have it before? What's the demographic? Would they have subscribed already? You have to kind of take a step back and do some analysis. Otherwise, you're probably more likely to be, you're not going to be as sure of your call than if you didn't do that.
You can choose not to answer this because I know you want to get to the banking part, but a big part of academic research talks about like herding among analysts. That could be on the buy side, right? The idea being it's okay to be wrong as long as you're not wrong alone, right? The idea is if you're in the group and wrong, you could say everybody else missed it too. So do you look at other do you look at what your competitors are doing? Does that come into play at all if you've got something very different than what let's say the rest of the street's saying?
Yes and no. Yeah, yes and no, absolutely. There is first call consensus. Maybe you touch on it in your classes where, there is the average, they have people's major estimates, it's revenue, EBITDA, EPS published. And then there's an average out there. And it's important to know what it is and look at it, only because not that you want to, be with the crowd and kind of, do what the herd is doing, but more that if you're not doing that, you need to know why, right? If someone says, well, your estimate is 50 cents and the street's at, 35, you have to answer the question, like, why are you 15 cents above consensus? Mm-hmm. So it is important to know what your peers are doing to that sense, because you need to have a reason that you're so different. And it could be a great reason. Maybe you have insight, maybe you have a real conviction, but maybe you're just off. Therefore, you might want to go back and look at your model again. So yeah, we don't necessarily try to change our opinion to go along with consensus. I don't think that really adds value, but we definitely want to be aware of what consensus is.
Thank you.
Alexia, you have 4 more slides to go and time is going through.
Let me keep going. Okay. I don't think we need to spend too much time here. This is just what happens with earnings. It's a big part of the job, which is earnings will come out 4 times a year in this country, either before the market close. I was actually showing my son the slide earlier and he's like, why can't it come out during the day? And I was explaining, if you're going to release important news, you're going to have it before the market opens or after it closes. You don't want to release it during the market because it creates too much volatility and frankly, no one has time to digest it. Then it's followed by an earnings call, which means that senior management will host a call and discuss the results. And then you basically, get on the phone and have, if you're maybe analyst 29 in the industry is not going to speak directly with management after earnings call, but the top 10 analysts in the industry will have a conversation, one-on-one conversation with the management teams. And then obviously the most important thing is to write up your thoughts quickly and get on the phone with clients. So that's what happens. So usually it's the time of the year that my team and I work really long hours. The rest of the year is not so bad. Okay, the next slide is, I think, did I skip one? I don't think so. Communication with the buy side. This is important. I remember years ago when I was probably most of your age, like just coming out of college and thinking about my career, maybe a little older than that, coming out of my MBA. I met with somebody on the sell side. He was a radio analyst. So this is how long ago it was, because radio was a huge sector. Now doesn't exist as a sector. And I asked him, what it takes to be a good equity research analyst. And he said, you have to be a marketer. You got to be a marketer. It's not about the analysis. It's not about the writing. It's about marketing. And you know what? There's some truth to what he said. You have to be personable to a certain degree. You have to want to talk to people a lot. You have to want to share your ideas. If you uncovered something, you have the best research in the world, and you're not good at communicating that research, it's worth nothing. It's worth nothing. So if you want to come in as a junior and just do models and write research reports, that's amazing. But if you want to eventually be an equity research analyst, you have to like to market. You have to like to talk to people. I love to market. I loved getting on the road, going to Boston, seeing at this point, they're old friends, and just sort of chatting with them about what I think about my stocks. And again, we don't talk about all 33. They pick the ones they're interested in. Those are the ones you talk about, or you just talk about the big ones. You go to Europe, you go to Asia sometimes, you go to the big cities in the US, or you just, during COVID, do Zoom calls and stay on the phone, but you're constantly sort of just staying in connection with your counterpart on the buy side. So again, you have a relationship with them and they know to come to you and not the guy at Morgan Stanley. I mean, they'll probably go to the guy at Morgan Stanley, he's good too, but you know what I mean? You're in the flow for sure. Okay.
And Alexia, just one thing, this is on the sell side, right? We're going to hear from somebody on the buy side in research, and they have a different tack.
100%. I think everything I'm saying on the sell side, to Tom's point, some of it is overlap, the analysis, the modeling, but in terms of the banking relationship, the marketing, all that specific to the sell side. Basic skill sets for the job. I thought it was important just to talk about this because we're always hiring people. The team's looking for 2 analysts right now. There's just, they're just because we're expanding our coverage and we lost somebody to the buy side. What people ask, what do you usually look for? So what I think makes a good junior person coming into this role, financial analysis. So taking great courses, in the MSB here, really understanding basic financial analysis, know how to build a financial model. There's always trainings, you don't know perfectly, but you have to know how to read a 10K, a 10Q, what the basic drivers of a model are, really understanding financial models and financial statement analysis. Industry knowledge, that usually comes, you don't necessarily walk in the door with it, but, learn the key themes in the industry, the trends that shape it, the data points, the data sources, and develop relationships over time with people in the industry that can help you. I often speak at conferences and on panels just because it gives you a bit more of a presence, and not on the investor side, but in the industry. So then if someone knows who I am, then I can call somebody and ask them for information. Like in a private company, they'll do that because they've seen me at a conference, they know who I am. Strong writing skills. I think this can be learned. I think if you went through Georgetown, you're probably a good writer. But the point with writing is to be able to convey a very clear message to the point, right? Don't go on and on and on. They get to the point of why this is an investment thesis. And then, like I mentioned before, marketing and branding skills are important. Last thing on marketing, the marketing is internal. This is again, sell side to Tom's point. You talking to the sales, the traders within the firm, speaking on the morning call, talking to clients, in-person meetings, and then industry conferences. You can go on, JP Morgan has sort of been different about TV. I like to go on CNBC, so I'm on it from time to time. Totally, they don't have a strong preference one way or the other if you want to be on TV. Last slide, I think, is the collaboration, other areas of the bank. This is specific to the sell side too. Talking to sales and trading, you want your traders and your salespeople to know what you're saying, because the more people that know what you're saying in JP Morgan, the more people can convey your message outside of JP Morgan. So make sure the people inside, so that means talking to the sales people, talking to the traders. Investment banking, we touched on this a bit in the Q&A, but working on IPOs, talking to bankers with a lawyer on the line, just about industry trends, making sure they're smart. All of this is super helpful and a big part of the job. You are involved in IPOs, you are involved in roadshows, you're involved in marketing the deals. Again, it's all with certain regulations, but if it's an industry that is active in the IPO market, you're gonna be very involved in them. So basically, it is a good chunk, especially in this market. I'd say I worked on 11 deals last year. and have several active deals right now. And then last thing, I don't know why I threw this on there, but mentorship. I think it's important to just, there's a lot of stuff JP Morgan likes you to work with other areas in the bank, mentor younger folks. I do a lot of that, probably because I've just been doing this for a long time. So I think that's it. Sorry if I've gone on for a long time. I'm happy to answer. Let me give a little 2-second promo. I absolutely love my job. I think equity research is a phenomenal career. I just think you sort of end up being your own boss in the sense you have your own little business. You decide when you want to write reports, not earnings. And it's just it's a wonderful mix of, financial analysis, writing, learning about an industry, talking to people. I think it's a great job, and I would recommend it to everybody who's interested in those, has those skill sets, interested in developing those skill sets. It also gives you a window into investment banking without having to do all the grunt work of investment banking. So I think that's an interesting balance as well. But I know I talked for a long time, so I'll stop there. If there's any other questions, I'm happy to answer them.
So there are some things. Maybe I'll try and summarize a little bit. James was actually asking about private companies, but I'll rephrase it slightly. One of the ways that we talk about valuation is, of course, multiples, comps and multiples, relative valuation. How do you pick your comps, right? So James's question was really about, private versus public companies, and when you may have scarce data on some of them, but just how do you pick comps?
Well, when it's a private company, which would be through the IPO process, we look at the public market, right, and the comps that are closest in the public market. And sometimes there aren't any comps, right? We could, I can't talk about IPOs we're working on now, but we could be working on a company. I'm working on one now that doesn't have any company out there like them. So we'll look then either at what companies have similar growth rates, similar profit margins, other aspects of the company. They may do something different, but they have attributes that are similar, and then we'll use that as a comp set. And we can often use 2 tiers of comps. We can say these are the most direct comps, but you can also look at this broader group of comps, maybe not as directly, but as a secondary measure, because they're not as directly correlated, but they're still relevant. In terms of the metrics specifically, whether it's EPS or EBITDA or revenue multiple, again, that will be determined by usually the comp set. If we're doing a very fast growing early stage, gaming or software company like AppLovin or Roblox, will tend to look at a revenue multiple, particularly if there's no EBITDA. In those cases there is, but if there's no EBITDA, and it really is what the comps are. Metric is for valuation is what we'll use for the new company.
Ian has a really, I think, in-depth but really good question. Coming back to sources of information, right? Do you ever rely on an expert to analyze, let's say, highly technical subjects related to innovation, patents, economic analysis, right? To really understand what a business is doing. Certainly, I mean, if you were covering perhaps biotech, that might be something that you absolutely would need to do. But do you visit the company? Do you, right? So just is this simply sitting in front of a Bloomberg terminal and downloading things?
Yeah. Yes, and yes is the answer. We always, again, pre-COVID or even during COVID, we always visit the company when we can, because I think you learn more in person than you do. And frankly, if COVID didn't exist and you were initiating research on a company, I would feel remiss if we hadn't met them in person, because I don't think you've really done your job if you haven't reached out and actually met them in person. We do visit companies. We could do, if I covered a different sector, like I used to cover printing and publishing, we would do tours of printing presses. God, this was so long ago. You probably wonder what even that is now. But, you do go visit the company if there's something to see. I remember when I was working in the Google IPO, we went and visited the campus because it was important to get a feel of the culture and the company. So yes, you definitely go visit. And yes, you use industry experts. If you're lucky to work for a bank that has the resources or willing to spend it, the first thing we did when Microsoft was buying Activision is we called a lawyer that we have on a retainer in Washington and asked his opinion on what is the likelihood of the DOJ is going to intercede here. What are the key issues? Absolutely go to third-party industry experts and ask them. We hire survey companies, do surveys. The more data points you can get that are independent, the better your research is going to be.
Alexia, it's good to see you, Alexia, by the way, has a question that is somewhat philosophical, which is, where do you sort of see the future of equity research going, right? We've seen the financial markets change dramatically, and for sure, let's call it the monetization of research has changed sort of dramatically. We now have independent analysts. Where do you see the future of equity research? Will it still be housed inside large financial institutions? Will it become more, I don't know, democratized, decentralized? Any thoughts?
Yeah, I mean, I think it depends on when you ask me. I mean, there were times in the 25 years that I thought, oh God, this business is going away. There people, investors using index funds more. They're not really doing independent stock buying. Commissions have gone down. IPO markets dried up. And then there's years like last year, 2021, where we just did banking deal after banking deal. And, there's a lot of volatility in the market. And I just felt, we were needed so much. And I think that the bank rewarded us, I mean, it fluctuates is my answer. I think there's some value to independence, but you have to make the financial model work. And without the banking side and the trading, I don't know if you always have the resources to have the top analysts. I think you'll find that the bigger banks tend to have more of the top analysts because they have the resources to put, behind them in terms of different revenue streams, right? Because we get paid both by commission, sales and trading, and investment banking. So I'm not quite sure charging for research really is a model that is very sustainable. There's some, I mean, you're going to hear from one, I don't know. There's some that have really mastered it, but it's harder to make it work because if you already have 30 analysts out there, how many firms are going to pay for one independently versus just, using them for after they have their relationship, from trading. So I think it's difficult to be independent.
In the last few minutes we have, I'd like to actually ask you, we have a lot of women on the call, and unfortunately, finance is still a very male-dominated, or for good or bad, it's a male-dominated industry. You have reached the pinnacle of a career. Do you have any advice, I guess, for anybody, but for young women in general, in terms of maybe how to negotiate, how to navigate this male-dominated field?
I would just say speak up, and demand what you deserve. I think I started in a period where there was a lot of discrimination. When I had a baby, there was no maternity. My first baby, there was no maternity leave. I asked my boss what to do. She said, hide it as long as you can, then take disability if you need to take more than 2 weeks off. I mean, I'm telling you, that's the world that I started in. Now it is much more women friendly than it ever has been. But the advice I'd give you is show your voice, stand up for what you deserve, speak out. Don't be intimidated, because if they think they can intimidate you, they will. So it's a great job for women because there's a lot of flexibility when you get to a senior level. So I think it's a wonderful career for a woman.
I would just like to add to that, having hired many people into equity research, women are terrific communicators. Mm-hmm. As Alexia had in one of her slides, communication of your research is extremely important on the sell side. And it is, when you, having managed many analysts, when you ask a male what's the best thing about their research, they'll tell you my earnings model. Mm-hmm. And when you ask a woman about it, she'll say, I just love the customer interaction and all the aspects of knowing the clients and bringing my research to them. And that is extremely important. And women do it extremely well. Jack Rivkin, who's one of the most famous research directors on Wall Street, went out of his way to hire more women than men just for that reason.
I'm glad you both mentioned that. So just for students of mine or students who are going to be mine, when I cold call you in class or I walk to the other end of the room and I say, I'm sorry, can you speak up? It is done intentionally, precisely because we want you to be confident in what it is you are doing. You're all very talented, but if you can't communicate that, you end up working for somebody who can communicate your talent. And I don't think that's where you, Alexia and Tom are nodding.
Completely true.
So want to
Totally
thank
true.
you, Alexia, for kicking off this inaugural Step Up seminar series. I want to remind everyone that there is another session tomorrow. It is Tim Nolan from Macquarie, and over the course of the next 3 weeks, you will have professionals come in who will have different views, right? Whether it's the sell side or the buy side, but also giving you different insights into equity research.